Hello and welcome to this episode of Nothing Ventured News for March 2026. A bit of a continuation from last month. Venture, is it back? I'm not entirely sure it is. Certainly the top of the market is still strong, but that breadth is still painful. Frontier AI is becoming really its own asset class, and it's something between sort of a startup and an infrastructure platform and a pre-public utility, because OpenAI has just announced $110 billion of new investment at a $730 billion pre-money valuation. That is massive. We have investors like Amazon, Nvidia, and SoftBank coming into this round. And it's not just about capital, because frankly, OpenAI gets 2 gigawatts of Amazon Trainium compute, and AWS becomes the exclusive third-party cloud provider for Frontier, OpenAI's enterprise agent platform, whilst Microsoft Azure still remains OpenAI's exclusive cloud provider for the APIs and for OpenAI's first-party products. Anthropic, on the other hand, just raised $30 billion at $380 billion post-money valuation in its Series G. But here's the real number to focus on. Global venture funding hit a record $189 billion in February. 83% of that went to OpenAI, Anthropic, and Waymo. 90% of February's global venture dollars went to AI startups. And at the early stage, 40% plus of 2026 seed and Series A dollars have already gone into $100 million plus rounds. This is platform capture and infrastructure capture, not optimism. Strategic investors are not just buying equity, they are really buying distribution, compute relationships, and frankly, a seat inside the control layer of AI. The venture market is starting to look a little bit unequal, a bit of a barbell going on, and we've talked about this bifurcation already in a couple of other episodes. We have a few giant labs at one end and really a much narrower set of application or tooling winners at the other. And frankly, if you are a B2B SaaS startup, you're not living in the same market as OpenAI and Anthropic. The question we have to ask ourselves is, if a private company is raising $110 billion, are we really still talking about venture? And if the labs become the new utilities, where does real venture alpha come from? Is it in the apps? Is it in orchestration? Is it in data? Is it in security? Or is it in distribution? Is this actually creating an opportunity below these labs, flattening the middle of the ecosystem on the other hand? I mean, it's really, really tough. It would be really easy for me to say that AI is hot, but that's frankly pretty obvious. The reality is that AI is no longer just a sector. It is where the market is deciding who gets to own the next computing stack. Because public software has been repriced hard on AI disruption fears. And once you accept that the money is concentrating, the next question is, who controls adoption? So who does control adoption? What we're seeing right now in real time is that private equity could become an AI distribution rail. Because the underrated March story is not about LP appetite. Private equity firms are becoming a distribution layer for frontier AI. We've had reports that OpenAI is in advanced talks with a variety of private equity firms to form a joint venture that would distribute OpenAI enterprise products across these firms' entire portfolios and beyond. This proposed venture was reported to be a $10 billion pre-money valuation with roughly $4 billion of private equity capital under discussion. Now, these private equity firms would get equity, they'd get early access to OpenAI tools, and they'd get influence over deployment. And frankly, they'd likely get board seats if the deal closes as well. Anthropic is also in discussions with the likes of Blackstone, Permira, and Hellman and Friedman on a similar distribution venture, with an equity stake of around $1 billion being discussed. OpenAI's enterprise business had reached $10 billion of annualized revenue out of a total annualized revenue of $25 billion, so almost 50%, according to a source. And both OpenAI and Anthropic are courting private equity because private equity firms control enterprise companies and influence software and AI budgets. Now, what this means is that private equity is no longer just an eventual buyer, a financial sponsor, an exit path. It's actually becoming the route to enterprise adoption, which is huge because that shifts power away from the old kind of mental model that we had of startups selling to the CIO and then maybe exiting a few years later. We're seeing a new budget hierarchy appearing, and that's lab to private equity sponsor to portfolio company. And that makes life a heck of a lot harder for smaller B2B startups that do not have a clean place in this stack. And so the question we have to ask ourselves is, if private equity owns a custom access, who really holds the power? Is it the AI lab or is it the buyout house? And does this speed enterprise adoption, or does it create a gated system where we have a few giant firms deciding which tools are going to get deployed? Because let's face it, private equity owns distribution amongst small and mid-cap businesses, and they are going to have huge decision-making power about what gets deployed and where. So are we actually seeing venture drifting away from discovery and further towards controlled deployment into pre-owned customer bases? We're also seeing retail access to private markets growing. Robinhood has floated a $658 million private markets venture fund, which would give access to retail investors to late-stage private companies like Databricks, Ramp, and Revolut. But private markets are not just getting bigger, they're also being repackaged for this entire new buyer class. With that said, in February, Josh Harris warned Reuters that pushing private markets to retail savers is not going to end well if liquidity risk is misunderstood. And this is something we've seen time and time again. You have a bubble in the market, retail investors come back in, and they're the ones often left holding the bag when things go south. We are at the moment also seeing a resurgence in SPACs. More on that in future episodes. But these PE lab deals are just in talks at the moment. They're not finalized transactions. But what it does tell us is that the strategic direction matters more than whether the exact terms have moved. So if adoption is concentrating, it shouldn't really be a surprise that exits are concentrating too. They're back, but only for a select few. That IPO window we've talked about on various episodes is open, but it is narrow, it is selective, and it is increasingly fragile. This isn't a clean reopening. It's more like an elite admissions system, right? This is the Ivy League of IPOs. Because the real facts are that Reuters reported a Goldman Sachs base case of $160 billion of US IPO proceeds in 2026, but these will be driven by marquee names. They also reported that several companies have already downside, postponed, or withdrawn IPOs this year as volatility and valuation scrutiny starts to bite. ClearStreet is the clearest example. It cut its IPO target by 65%, then delayed, then withdrew altogether. On the 11th of February, Reuters also reported that the S&P 500 Software and Services Index was still about 25% below its 28th of October record. And bankers were explicitly linking the chill in M&A and IPOs to AI-driven uncertainty over software business models. And I think we're seeing that throughout the stack. But Stripe's latest tender valued the company at $159 billion, giving liquidity to early employees as well as investors. That's up more than 70% from a year ago, showing that the strongest private companies still have that option to stay private. In fact, they've explicitly said, why wouldn't they? Foam PE paused its IPO plans on the 16th of March because of geopolitical tensions and market volatility. Reuters said it was targeting a valuation of $9 to $10.5 billion. But Relativity confidentially filed for a US IPO on the 19th of March, which is useful proof that the window is not shut. It's just becoming more and more demanding because there are now three lanes. You've got the elite companies that can list well, the elite companies that do not need to list, and the large middle cohort that is essentially still stuck. Mega IPOs can create the impression of a healthy market whilst actually crowding out the smaller names. That headline window is open, but the practical window is still narrow. So we have to ask ourselves, is the exit market genuinely back or just back for companies that the market can't ignore? And do mega IPOs signal health, or are they simply just another expression of this concentration we're seeing throughout the venture ecosystem? And if late-stage private capital is available, why list at all? Unless you need the liquidity, the currency, or the credibility. So the exit problem is not solved, but the best assets do have options again. The average backlog company still does not. And when exits are this uneven, the unglamorous stuff starts to matter. That's market structure, legal frameworks, and liquidity plumbing. And that's what Europe is trying to fix right now. So the most interesting story for Europe in March is not just another policy slogan. It's potentially a real attempt to address the structural reasons that founders scale elsewhere. And that's down to fragmented company law, weak liquidity, and poor exit routes. The European Commission launched its targeted consultation on private equity exits on the 2nd of March. Responses are due by the 27th of April. And they say that the consultation is about barriers to existing private equity investments, the design of a platform for intermittent multilateral secondary trading of private company shares, and whether such a platform could also help raise new equity capital. The consultation says this should not replace IPOs, but it should make private markets more attractive and help companies prepare for public markets. They explicitly warn that poor exit options can reduce liquidity, weaken venture and growth funds, and push high-growth firms to move abroad. Well, duh. We've seen that time and time again. European companies do not scale an exit in the US, at least at the moment. On the 18th of March this year, the Commission also proposed the EU Inc., an optional EU-wide corporate framework. This would allow formation within 48 hours for less than €100, with no minimum share capital requirements, fully digital procedures, EU-wide stock option plans, and simplified insolvency procedures. They want the Parliament and Council to reach agreement on EU Inc. by the end of 2026. But there are limitations. Companies would still be subject to national labor, tax, and social rules, which, if anyone has operated in some of the countries within the EU, will realize is a massive barrier. But what it means is that Europe finally seems to have understood that startup policy is not just about grants or warm words and rhetoric. The real game is now, how easy is it to form, fund, scale, trade, and exit? And if Europe can improve formation and secondary liquidity, it may keep more companies at home for longer. So is Europe finally diagnosing the right problem? And does EU Inc. actually change founder behavior? Or, frankly, do tax and labor fragmentation still overwhelm that benefit? And could better private share liquidity make European growth investing more attractive before IPO? This isn't a magic fix, but Europe has finally started trying to fix the layers that actually determine whether companies stay, scale, and exit in Europe. So if frontier AI is hogging the spotlight, and it would be hard to argue that it isn't, where is money still going when it is not going to these labs? Well, non-AI funding hasn't disappeared, but it does now go mainly to sectors that feel strategic, defensible, regulated, mission critical, or infrastructure-like. Crunchbase reported that defense tech raised $8.5 billion in 2025, an all-time high, and more than double the prior year. Reuters reported on the 5th of March that Sierra Space raised $550 million at an $8 billion valuation. And that explicitly ties investor appetite to national security assets, geopolitical tension, and commercial space infrastructure. They also reported that Belgian cybersecurity startup Aikido raised $60 million at a $1 billion valuation in January, becoming one of Europe's first new unicorns of 2026. Now, if you've been paying attention, we recorded a podcast last year with Andrea Soni, a PhD in AI, who talked explicitly about the winners from AI were likely to be cybersecurity businesses, because that surface area of attack just increases exponentially as AI continues to grow. Reuters also noted that Google had completed its $32 billion acquisition of Israeli cyber company Wiz, and that London overtook San Francisco and New York as the top fintech hub, according to Finch Capital data. Now, that report said Europe and the US each saw about 40 billion euros of fintech funding between 22 and 25, with Europe up 37% and the top US hubs down by 13%. So what does this actually mean? It means that outside frontier AI, money still wants moats and urgency. Cyber increasingly looks like part of the AI trade because AI expands that attack services I just mentioned and makes agent security a live budget item, whilst defense, space, and other hard tech assets work because they combine geopolitical relevance, procurement visibility, and infrastructure-like characteristics. Fintech is still alive, but the bar is much higher. You need scale, distribution, trust, or regulation on your side. So which sectors actually still have pricing power in 2026? Is cyber now a core AI layer than a separate funding bucket? And is defense tech momentum durable or just a spike given recent events? It isn't the case that everything outside AI is dead, but outside AI, capital has become strategic rather than casual. Across all of these themes, the pattern is the same. concentration of money, concentration of distribution, concentration of exits, and now concentration of policy attention. There are a few things worth touching on. We've seen SpaceX and xAI combine as a symbol of a mega-scale private capital, with SpaceX valuing at $1 trillion. It set a new record for the largest M&A deal ever. It also tied the merger to a possible blockbuster IPO backdrop later this year. The biggest private tech assets are starting to behave like sovereign-scale capital market stories. And we're seeing that with companies like ByteDance, with General Atlantic selling shares at a valuation of about $550 billion, up 66% from the previous employee buyback level, and up from a $480 billion secondary transaction in late 2025. So these private assets can still re-rate higher even before a public listing. M&A value is rising, even though the deal count feels selective. And I think this is what we are going to continue to see. The big deals are going to get bigger, and that's going to squeeze all the little guys. Once again, this has been Nothing Ventured with me, Arish Shah. Remember, whatever you're doing, stay liquid.